Good morning, multi-bagger hunters. Welcome back to the Daily Hunt, your go-to source for AI-generated market commentary and speculative analysis on this Wednesday, January 7th, 2026.
That's right, Ethan. We've got quite a bit to unpack from yesterday's data. Our systems flagged numerous stocks across diverse sectors, indicating a pretty active market. Sentiment is, a real mixed bag today. We're seeing some strong bullish conviction around certain growth stories, but also a healthy dose of skepticism and caution on others, especially those with, less than stellar fundamentals.
Definitely a day to put on our investigative hats. Let's jump right into the discussions. Kicking things off with Novo Nordisk, symbol NVO. We've seen some very positive buzz around this one, Brooke. Users are pointing to successful call options, anticipation of their GLP-1 product, Wegovy, really taking off, and some even calling it severely undervalued despite competition. Our AI insights are cautiously bullish, actually, upgrading it from a stay-away rating recently.
Cautiously bullish indeed, Ethan. While the sentiment is high, and I've noted the excellent return on equity at over 71% and a PE ratio of just 15, which is quite low for its sector, we can't ignore the competitive pressures from Eli Lilly. News shows LY is actively developing oral obesity treatments, directly confirming those user concerns. Also, the stock is significantly off its 52-week high, which could be an entry point or a sign of underlying issues that caused that drop. For NVO, considering the strong fundamentals and growth catalysts, our AI models are suggesting a buy for now.
All right, a buy for Novo Nordisk. Next up, Netflix, NFLX. This one's got a lot of if only I had held energy. Users are regretting selling too early, with some discussions talking about missing out on 10x returns. It's attracting significant investor attention, especially with that big WWE content partnership. The sentiment is bullish.
It certainly has, Ethan, and the KPIs support the growth narrative. A strong return on equity at 42% and solid revenue growth of 17%. The high PE of 37 does suggest investors are pricing in future growth, but that WWE partnership is a huge catalyst for potential subscriber engagement and future revenue. It's a clear upgrade from its previous stay-away ratings. Our analysis points to a buy for Netflix.
Moving on to CrowdStrike, CRWD. This one's a favorite among tech enthusiasts, with talk of their Falcon Flex eating competitors' lunch and driving massive ARR growth of 23% year over year. There's a strong belief in their superior security technology. Bullish, very bullish sentiment here.
I hear the bullish shouts, Ethan, and their revenue growth is certainly impressive at 22%. But, and this is a big but, their net profit margin is negative, and so is their earnings per share. They're simply not profitable right now. Add to that an exceptionally high price-to-book ratio of nearly 29 and a high debt-to-equity ratio of 20, plus some insider selling. And you have a stock that, while technologically advanced, is deeply overvalued by traditional metrics. Our models, despite the excitement, are sticking with stay away for CrowdStrike.
Let's talk NVIDIA, NVDA. This chip giant is always a hot topic. We're seeing news about their new Vera Rubin NVL72 platform being offered in the US and Europe through a partnership, driving more AI momentum. Despite some debates around valuation, the underlying sentiment seems to be that NVIDIA keeps innovating. Our AI has rated it everything from stay away to buy and speculative gamble in recent months.
Well, the numbers for NVIDIA are undeniably strong, Ethan. A staggering 62% revenue growth, a net profit margin of over 53%, and a return on equity above 107%. These are truly exceptional. However, it comes with a high price-to-earnings ratio of 46 and a very high price-to-book of 38, reflecting huge expectations. There's also a high debt-to-equity ratio of 9 and some insider selling. The market is pricing in a lot of future success. But considering the sustained growth and profitability and new platforms like Rubin continuing to launch, our AI insights are classifying NVIDIA as a buy.
Next, Nebulous Group, NBIS. This one is tied directly to NVIDIA's AI future, delivering capacity for the Vera Rubin NVL72 platform. It's a significant strategic partnership, suggesting big growth potential in the AI infrastructure market from late 2026. The AI insights are leaning bullish, especially given its stock has gone from $30 to $100 in the last year. The future potential is there, Ethan, I'll give you that, but current KPIs are flashing red. Nebulous is deeply unprofitable, with a negative earnings per share and a heavily negative operating margin. Their debt-to-equity ratio is an alarming 94.97, indicating massive leverage. While the NVIDIA partnership is exciting news, these improvements are future-oriented. For now, the financial fundamentals tell us to stay away. Over to Amazon, AMZN. Users are calling it solid, and news talks about it being a trending stock and a leader in S&P 500 buys. There's a lot of talk about its ongoing spending spree fueling future growth.
Amazon certainly has strong fundamentals like 13% revenue growth and over 11% net profit margin, Ethan. But it's trading very close to its 52-week high, and that high PE of 34 means a lot of future growth is already priced in. What really gives me pause here is the significant insider selling. Over 16.5 million shares sold in the last 6 months. That's a strong cautionary signal from those who know the company best. Our AI is advising to stay away for Amazon right now.
All right, let's talk about AST Space Mobile, ASTS. This one is a pure life-changing money story for many users. People are celebrating 700% gains, regretting selling early, and have conviction to hold for $300 to $500 targets. The Bluebird 7 hype and talk of future defense communication growth are really fueling this. It's been a speculative gamble in the past. Ethan, the user sentiment for ASTS is overwhelmingly bullish, but the KPIs are overwhelmingly not. This company is fundamentally unprofitable, negative EPS, a net profit margin of 0, and a heavily negative operating margin. Its price-to-book ratio is an astonishing 21.37, meaning it's highly speculative. And let's not forget that beta of almost 2.7, signaling extreme volatility. Plus, there's significant insider selling, which conflicts with all that community optimism. While Bluebird 7 could change things in the future, the current financial health combined with a speculative valuation forces us to classify ASTS as a stay away. All right, a firm stay away for ASTS today. How about Meta Platforms, Meta? Our AI insights show a bullish leaning here, driven by strategic moves like their massive AI startup acquisition and continued development of the Phoenix MR headset, showing a long-term vision for the metaverse. Last rated, a buy. And the financials look solid to support those ambitions, Ethan. Meta boasts 26% revenue growth, a fantastic 30% net profit margin, and over 40% operating margin. What's more, insiders have been buying a substantial amount of shares, almost 2 million net shares purchased in the last 6 months. That's a huge vote of confidence. Despite some delays on specific products, the core financial strength and strategic direction for AI and MR are very strong. Meta is a buy. Next, Tesla. TSLA. This is another one that prompts user regret for not holding on to past gains. Some refer to it generating 10x returns. However, the news isn't as rosy, with lower than expected Q4 deliveries and concerns about China sales. It's been a stay away or speculative gamble for us.
It's true, Ethan. The historical performance was impressive, but current KPIs are a major concern. An astronomical PE ratio of over 300 screams overvaluation for its current growth rate of 11.6%. The debt-to-equity ratio is also very high at 17, and analysts are calling it 5x overpriced. Those missed delivery estimates and increased competition signal headwinds. Despite some insider buying, the risks are simply too high for the current valuation. For TSLA, it's a stay away.
Moving to SoFi Technologies, SOFI. This is interesting as users are taking a contrarian stance, viewing a recent Goldman Sachs downgrade as a buy signal. Many are actively going long, anticipating strong Q4 earnings. It was a stay away recently.
It's a classic Wall Street bets move, isn't it? The 37% revenue growth is strong, and a substantial 13% net insider buying adds credence to the bullish sentiment. However, that PE ratio is still high at 48, and the debt-to-equity ratio is an extremely elevated 31.99. While a Q4 earnings beat could certainly help, that level of debt is a significant risk factor. Given the strong insider conviction and growth, but also that high debt, we're rating SoFi a cautious buy.
And now, Rocket Lab, RKLB. While some users are loaded to the tits on this one, the comments we're seeing lean bearish, with talk of the stock being good enough to sell. They did just win their biggest contract ever, but analysts are also questioning its sky-high valuation. It's been rated a stay away frequently.
Ethan, the community's caution is well-founded. Rocket Lab is currently unprofitable with negative net profit margin and EPS. Its price-to-book ratio is an incredibly high 33.33, suggesting extreme overvaluation. And the insider selling over 6 million net shares in the last 6 months is a major red flag. Despite the big contract win, that future potential is largely priced in, and the current financials and insider actions tell us to stay away for Rocket Lab. Speaking of caution, let's look at MicroStrategy, MSTR. The user sentiment is strongly bearish, with concerns about asymmetric volatility compared to Bitcoin and talk of dilution. Some are even saying it's going to zero. It's mostly been a stay away or speculative gamble for us. Indeed. The beta of 3.43 confirms the extreme volatility users are seeing. A high debt-to-equity ratio of over 14 adds significant financial risk, especially with news of widening Bitcoin losses. It's trading near its 52-week low. MSTR is fundamentally a highly speculative play tied to Bitcoin, but with added corporate risks. It's a clear stay away.
Our next stock is New Fortress Energy, NFE. We're seeing a hot rumor about a large FEMA payment, with one user saying it would be huge for the stock and take bankruptcy off the table. It's rated stay away often.
Ethan, a hot rumor for sure, but the fundamentals are icy cold. An astounding debt-to-equity ratio of 827.97, deeply negative net profit margin and EPS, and negative revenue growth. The stock is near its 52-week low, and news confirms credit concerns and S&P downgrades. Even a large payment won't fix such deep-seated financial issues overnight. We have to be disciplined here. Stay away.
Moving to Ondas Holdings, ONDS, users are celebrating profits and recent gains, with the stock hitting a 4-year high. There's talk of autonomous systems orders, rebrands, and a bold prediction for it to explode higher. It's been a stay away for us previously.
The momentum is certainly evident in the price action, Ethan, but the underlying company is unprofitable with negative net profit margin and EPS. It also has a high price-to-book ratio of 8.7 and a significant amount of insider selling. While the upcoming investor day might provide a clearer path to profitability for its autonomous systems, based on current financial health, our AI models are sticking to stay away for Ondas Holdings.
Finally, let's circle back to Alphabet, Google. While some users are skeptical about a niche AI benchmark moving the stock much in the short term, there's a strong underlying belief in Google's long-term AI leadership and consistent growth. It's been a consistent buy for us.
That skepticism on short-term catalyst is warranted, Ethan, especially with a PE of 31 and the stock near its 52-week high, indicating much of the good news is already priced in. However, the long-term picture is compelling. 15.9% revenue growth, a superb 32% net profit margin, and significant insider buying. These strong fundamentals, coupled with their AI leadership, make Alphabet a solid long-term buy.
All right, let's wrap up our hunt for today. Here's a quick roundup of the stocks we think warrant further investigation. Investigate as buy, Novo Nordisk AS, NVO, Netflixinc.com, NFLX, NVIDIA Corporation, NVDA, MetaPlatformsInc.com, META, AlphabetInc.com, GOOG. Investigate as cautious buy, SoFiTechnologiesInc.com, SOFI. Investigate as speculative gamble, AstaSpaceMobileInc.com, ASTS. And that brings us to the end of today's Daily Hunt. Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Absolutely. Thanks for joining us, and we'll be back tomorrow with more insights from the Daily Hunt for Multibaggers.